The U.S. Federal Reserve has kept interest rates unchanged. Here to give us his thoughts is Sam Chai of TD Asset Management. And Sam, what really jumped out at you from today's Fed decision?
Like you said, Anthony, today's hold by the Fed is a consensual decision. The market is focused on how the Fed characterized the Middle East conflict, by which the Fed couldn't give simpler language, which is that it is an uncertain development. That's it. I think what's more interesting is their new economic projection forecast. So essentially, the Fed has painted a pretty benign, somewhat reflationary pictures. In particular, they have revised up the GDP growth a little bit. They have revised up the headline PCE numbers slightly less, but still higher core PCE number as well, and expect that the unemployment rate be unchanged this year. Finally, they continue to expect one cut this year, followed by another cut next year, and finish. So essentially, still a pretty good macro backdrop they conveyed.
Okay, so given that macro backdrop, how much does rising oil prices and the Middle East conflict, how much is that weighing on the Fed decision?
I think it makes sense. They characterize it as uncertain, although maybe it's a bit too simple of a language. But it makes sense for them to be patient and to, in essence, see and wait for more development before they react to it. Because in reality, assuming that the energy disruption is more temporary, the actual impact and path-through to core inflation likely would be pretty limited. Same for the employment activity side, the disruption should be quite small as well. This is because the U.S. being a net oil exporter and also have a more insulated natural gas domestic market as well, have much better cushion for those inflation path-throughs. Just to quantify a bit, the headline inflation impact from the energy price rise for the U.S. is maybe approximately 50% that of compared to the Europe. It is important to monitor the situation, however, because there are non-linear effects the oil price can have on the economy. So if we're talking about a scenario where oil goes to 150 or even higher and stay there, what will happen is that there will be a path through to core inflation. There could be, starting to see the anchoring of inflation expectations or even second round effect. And then it will also be weighing on the economy possibly much more materially. So those pose risk. But as of right now, it's not, a meaningful change to their expectations.
Okay, so if we do see inflationary pressures increasing potentially later this year, do you still see room for a cut, or could we see the Fed being on hold the full year?
So maybe let's first talk about what the market pricing right now is. Market now place pricing just shy of one cut by the end of this year. Essentially, from a 2.5 to 3 cuts just before the Iran conflict. And this is the market really saying that, okay, the level and the duration of energy price is a key input to the Fed's policy path, rightfully so. The current energy price base case, which I think is a reasonable base case, the market pricing in, is essentially that we'll see a gradual drop in energy prices. Perhaps oil goes to $70 to $80 by later this year. If that scenario is to materialize, I would say that the base case will be that the Fed will be able to deliver more rate cuts in the second half this year. If oil price goes to 150 plus and stay there, that's going to be a much more difficult job for the Fed to react to, and may actually freeze any rate cuts they're considering, or even have to force them to consider the tightening side as well. But I think as of right now, that remains a tail risk scenario.
Okay, let's take a look at what's happening in the bond market, particularly bond yields. What are they telling us about where policy could be headed? Especially, as you know, there's still a lot of uncertainty around the Kevin Warsh nomination. We've got that investigation of Chairman Powell. Could there be a scenario where the Chairman Powell, when his term ends in May, is there a potential for him to remain on longer if the nomination doesn't come through for Kevin Warsh?
Yeah, so that's a very interesting question. To date, Chair Powell has been keeping his card, hasn't really commented on that for good reasons. But the market base case right now is, I'll call it assigning a 2/3 of odd that he actually stepped down. by June when his term ends. But if he does decide to stay on, that would mean that we may have a less dovish reaction function change than just under Chair Warsh and the Fed and Powell actually leave. In terms of what the bond market is telling us right now, so the bond market, I think, tells a more medium-term story. Terminal rate pricing right now for the Fed policy path is essentially one cut this year, one cut next year, and done. For that scenario to play out, the market assumption is that labor market remains solid and good, essentially, over that time period. Inflation accelerates from here, but not just that, but they actually stay elevated for some time, such that the Fed can maybe give a bit more easing, but no more that provide more accommodation to the economy. My assessment is that the risk, I think that's a reasonable base case given information we know right now, but I would assess that the risk is skewed towards perhaps some more lower terminal rate pricing and more rates cuts. For one, we talked about this marginal dovish shift in reaction function under Chair Warsh in the second half, but also there are still tail risks from private credit, tail risks from AI disruptions. And one more thing I'll point out is that the Fed currently assumes that labor market will not weaken any further this year, and they're projecting one cut. What if unemployment rate continue to tick up? That is going to be a dovish risk that the Fed need to take into considerations.
All right, let's talk about the U.S. dollar, because we've seen the U.S. dollar benefit from this flight to safety, particularly since the start of the Iranian conflict. Where do you see the dollar going from here?
The dollar, to your point, has benefited, very much month to date on the back of higher energy prices, rising geopolitical risk premium, and also just a general cross-asset volatility rise. In essence, dollar benefited from being both a safe haven currency and also that, just the fact that U.S. being a net oil exporter as well. So to the extent that we continue to see persisting Iran conflict, I think U.S. dollar can continue to exhibit strength versus non-commodity currencies in the G10 space. That's a tactical view. On a more medium term, I think the risks continue to skew towards more dollar weakness. We talked about earlier that the risk distribution skews, in my opinion, towards more rate cuts being priced in for the Fed. And with that could come with a higher dollar hedging flow as well later this year.